Let me ask you a question that reveals everything about how you really think. If you lost everything tomorrow, every dollar, every investment, every asset, and you had to start over from absolute zero with nothing but the knowledge you've accumulated, what would you do? Most people panic when I ask this. They imagine the catastrophe, the loss, the embarrassment, the fear. But I don't see it that way. If I lost everything tomorrow, I wouldn't be scared, I wouldn't be depressed. I'd be excited because I know exactly what I would do to rebuild, and I could do it faster and better than the first time because I have something that can't be taken away. Knowledge, experience, judgment earned over 9 decades of investing. You can take my money. You can't take what I know, and what I know is worth far more than any amount of capital. Today, I'm going to share exactly what I would buy if I had to start over from scratch. Not individual stocks, not bonds, not complicated strategies, just 4 exchange-traded funds. 4 simple, low-cost index funds that would form the foundation of my entire portfolio. These 4 ETFs represent everything I've learned about diversification, risk management, capital allocation, and long-term wealth building. They're not exciting. They're not going to make you rich overnight, but they will make you wealthy over decades if you have the discipline to buy them and hold them and ignore everything else. Before I tell you the 4 ETFs, let me explain why I would choose ETFs at all. For most of my career, I've picked individual stocks. That's what I'm known for. Finding great businesses like Coca-Cola and American Express and Apple and holding them forever. That approach works, but it requires enormous amounts of time and skill. You have to read hundreds of annual reports. You have to understand accounting. You have to evaluate management. You have to assess competitive advantages. Most people can't do this. They don't have the time. They don't have the expertise. They don't have the temperament. And even among professionals who dedicate their entire careers to stock picking, more than 90% fail to beat the market over long periods. So if I were starting from scratch today, I would not try to pick individual stocks. I would do what I've told everyone else to do for decades: buy low-cost index funds and hold them forever. ETFs, exchange-traded funds, are perfect for this. They're baskets of stocks that trade on exchanges like individual stocks. You get instant diversification across hundreds or thousands of companies. You get professional management with minimal fees. You get liquidity. You can buy and sell anytime. And you get simplicity. You don't have to research individual companies or make constant decisions. You just buy and hold. The 4 ETFs I'm going to share give you complete exposure to global markets: U.S. stocks, international stocks, bonds, and real estate. With just these 4 funds, you own pieces of thousands of companies around the world. You're diversified across industries, geographies, and asset classes. This is the ultimate financial resilience. Let me tell you about the first ETF. The first ETF I would buy is VTI, the Vanguard Total Stock Market Index Fund ETF. This fund owns every publicly traded stock in the United States. Large companies like Apple and Microsoft, mid-sized companies, small companies, everything. About 4,000 stocks total. When you buy VTI, you own a piece of the entire U.S. economy. Let me explain why this is so powerful. The United States has the most dynamic, innovative, competitive economy in the world. We have the best universities, the best entrepreneurs, the strongest rule of law, the deepest capital markets, the most consumer spending. Companies from around the world want to list their stocks on U.S. exchanges because that's where the capital and liquidity are. This isn't blind patriotism. This is fact. The U.S. stock market has outperformed every other major market over the past century. $1 invested in U.S. stocks in 1926 has grown to over $10,000 today, including dividends. The same dollar in bonds grew to about $100. In cash, it would be worth less than $1 after inflation. Stocks, specifically U.S. stocks, are the best long-term investment in history. VTI captures this entire market. The largest holdings are companies everyone knows: Apple, Microsoft, Amazon, Alphabet, Nvidia, Meta, Tesla, but you also own thousands of smaller companies, retailers, manufacturers, banks, healthcare companies, energy companies, every sector, every size, every part of the economy. The current dividend yield on VTI is about 1.5%. Not high, but that's not the point. The point is total return, dividends plus capital appreciation. Over the past 50 years, the U.S. Stock market has returned about 10% annually on average. Some years up 30%, some years down 20%, but over long periods about 10%. If you invest $100,000 in VTI and it compounds at 10% annually for 30 years, you end up with about $1.7 million. That's the power of owning the U.S. stock market. The expense ratio on VTI is 0.03%, 0.03%. That's $3 per year for every $10,000 invested. This is essentially free. Compare that to actively managed mutual funds that charge 1% to 2% annually and usually underperform VTI anyway. You're getting the entire U.S. stock market for almost nothing. Now let me address concerns about VTI. Warren, isn't VTI risky? Won't it crash during bear markets? Yes, VTI will fall during bear markets. In 2008, it fell about 50%. In 2020, during COVID, it fell about 35%. This is the nature of stocks. They're volatile. But here's what people miss. If you held VTI through both crashes, you recovered fully and went on to new highs. The investors who panicked and sold locked in their losses. The investors who held or kept buying made fortunes. VTI isn't risky if you have a long time horizon. It's only risky if you need the money next year and might be forced to sell at a bad time. If you're investing for 10, 20, 30 years, the short-term volatility doesn't matter. It's just noise. Warren, what if the U.S. economy declines? What if China overtakes us? The U.S. has been the dominant economic power for over a century. We faced 2 world wars, a Great Depression, multiple recessions, political turmoil, social upheaval, and countless predictions of decline. And yet, the economy keeps growing. The stock market keeps reaching new highs. Why? Because American capitalism is incredibly resilient. Companies adapt. Innovation continues. Entrepreneurs find solutions. This isn't guaranteed to continue forever. But betting against America for the past 100 years has been a terrible decision. I'm not betting against America for the next 100 years. Warren, isn't VTI too heavily weighted toward large tech companies? Isn't that concentration risky? VTI is market cap weighted, which means larger companies represent a bigger portion of the fund. The top 10 holdings are about 25% of the fund. Most of those are large tech companies. This concentration exists because these companies have become huge by being successful. Apple is the largest company in the world because it built products that billions of people want to buy. Microsoft is massive because virtually every business relies on its software. This isn't arbitrary. It's earned. And if these companies start failing, they'll naturally become smaller portions of the index. The beauty of market cap weighting is that it's self-correcting. Winners automatically become larger positions. Losers automatically become smaller. VTI is the foundation of a portfolio. If I could only own one investment for the rest of my life, it would be VTI. But I wouldn't own just one investment. I would own 4. Let me tell you about the second ETF. The second ETF I would buy is VXUS, the Vanguard Total International Stock Index Fund ETF. This fund owns stocks in developed and emerging markets outside the United States. Europe, Japan, Canada, Australia, China, India, Brazil, everywhere except the USS. About 8,000 stocks total. Let me explain why international diversification matters. The United States is about 60% of global stock market value. That means 40% of the world's publicly traded companies are outside the US. Some of these are excellent businesses. Nestle in Switzerland, Samsung in South Korea, ASML in the Netherlands, TSMC in Taiwan, Alibaba in China. These companies have competitive advantages, strong management, and growth opportunities. By owning only U.S. stocks, you're ignoring 40% of the global opportunity set. That's unnecessarily limiting. VXUS gives you exposure to international markets without having to pick individual countries or companies. You own developed markets like Europe and Japan, where economies are mature and stable. You own emerging markets like China and India, where economies are growing rapidly. The mix adjusts automatically as markets grow or shrink. The current dividend yield on VXUS is about 3%, higher than VTI because many international companies pay higher dividends than U.S. companies. European and Asian companies tend to return more cash to shareholders as dividends rather than buybacks. Historical returns on international stocks have been lower than U.S. stocks over the past decade, about 6 to 7% annually compared to the U.S. 10%, but there have been periods where international outperformed. In the 2000s, international stocks significantly outperformed U.S. stocks. Market cycle, sometimes U.S. leads, sometimes international leads. By owning both, you capture returns from wherever they occur. The expense ratio on VXUS is 0.07%, 0.07%. Still incredibly cheap, slightly higher than VTI because international investing involves more complexity and costs, but still far lower than actively managed international funds. Now let me address concerns about VXUS. Warren, why would I invest in international markets when the U.S. market is clearly superior? The U.S. has outperformed recently, but that's not guaranteed to continue. Valuations in the U.S. are higher than in many international markets. The price-to-earnings ratio of the U.S. market is about 22. Many international markets trade at 15 or 16 times earnings. This valuation gap suggests international stocks might offer better returns going forward. I'm not saying they will, I'm saying you don't know. And when you don't know which market will outperform, you own both. Warren, aren't international markets riskier? Political instability, currency fluctuations, weaker regulations. International markets do have additional risks. Currency risk because you're exposed to the euro, yen, yuan, and other currencies. Political risk in some emerging markets, less transparent accounting standards, but diversification across 8,000 stocks in dozens of countries mitigates much of this. And remember, international companies are global businesses. Nestle sells products worldwide, not just in Switzerland. Samsung sells phones everywhere, not just in South Korea. Many international companies get significant revenue from the U.S. and other markets. The lines between domestic and international are blurry. Warren, you've always said to invest in what you know. I don't know international markets. You don't need to know international markets when you're buying a total market index fund. You're not picking individual stocks or countries. You're buying everything and letting the market sort out the winners and losers. This is diversification. You're reducing the risk of being wrong about which markets or companies will succeed. VXUS is the international complement to VTI. Together, they give you the entire global stock market. About 60% U.S. through VTI and 40% international through VXUS. This is proper global diversification. Now let me tell you about the third ETF. The third ETF I would buy is BND, the Vanguard Total Bond Market Index Fund ETF. This fund owns U.S. investment-grade bonds, government bonds, corporate bonds, mortgage-backed securities, about 10,000 bonds total. Bonds serve a different purpose than stocks in a portfolio. Stocks are for growth. Bonds are for stability and income. When stocks crash, bonds typically hold steady or even rise as investors flee to safety. This stability is crucial for staying invested through volatile periods. BND currently yields about 4.5%. Every year you receive about 4.5% of your investment and interest payments. This income is predictable. Unlike stock dividends, which can be cut, bond interest is contractual. Borrowers must make the payments or default. The average duration of bonds in BND is about 6 years. Duration measures interest rate sensitivity. A 6-year duration means if interest rates rise 1%, the fund loses about 6% of its value. If rates fall 1%, it gains 6%. This moderate duration balances yield and risk. Longer duration would offer higher yields but more volatility. Shorter duration would be more stable but lower yields. 6 years is a reasonable middle ground. Over long periods, bonds have returned about 5 to 6% annually, lower than stocks, but with much less volatility. In 2008, when stocks fell 50%, bonds were flat or slightly positive. This stability is valuable. The expense ratio on BND is 0.03%, same as VTI. You're getting diversified bond exposure for essentially nothing. Now let me address concerns about bonds. Warren, you've said bonds are terrible investments. You've called them certificates of confiscation. Why are you recommending them now? Context matters. When 10-year Treasury bonds yielded 1.5% and inflation was 3%, bonds were terrible. You were guaranteed to lose money in real terms. But now bonds yield 4.5% and inflation is around 3%. You're earning a positive real return. The math has changed. Bonds make sense again at current yields. Warren, won't bonds get crushed if inflation spikes again? If inflation goes to 6 or 7% and the Fed raises rates aggressively, yes, bonds will lose value temporarily. BND could fall 10 to 15%. But here's the key. As bonds in the fund mature, they're replaced with new bonds at higher yields. Your income increases. Over time, higher yields compensate for the short-term price decline. And if you're reinvesting the interest, you're buying more shares at lower prices, which accelerates your recovery. Warren, why not just hold cash instead of bonds? Cash currently yields about 5% in money market funds, higher than BND's 4.5%. But cash yields fluctuate with short-term interest rates. If the Fed cuts rates to 3%, your cash yield drops to 3%. BND's yield is more stable because it holds bonds with maturities averaging 6 years. The yield doesn't change dramatically with short-term rate moves. Also, bonds have more potential for capital appreciation. If rates fall, bond prices rise. Cash doesn't appreciate. For diversification and stability in a portfolio, bonds are better than cash. BND provides the ballast that allows you to hold stocks through volatility. It's the shock absorber. Without it, many investors panic during crashes and sell stocks at the worst time. With bonds providing stability, you can stay calm and hold stocks for the long term. Now let me tell you about the fourth and final ETF. The fourth ETF I would buy is VNQ, the Vanguard Real Estate Index Fund ETF. This is the same REIT fund I discussed in my income investment video, and it belongs in this portfolio too. VNQ owns about 160 real estate investment trusts. These are companies that own income-producing properties, apartments, shopping centers, warehouses, office buildings, data centers, cell towers. They collect rent and distribute most of it to shareholders as dividends. Real estate provides diversification because it doesn't move in lockstep with stocks or bonds. It has its own drivers. Population growth, urbanization, e-commerce, creating demand for warehouses, cloud computing, creating demand for data centers. These trends are independent of what's happening in the stock or bond markets. VNQ currently yields about 4%, higher than VTI's 1.5%. This extra income is valuable. The dividend also tends to grow over time as rents increase. Not as fast as stock dividends, but faster than bond interest, which is fixed. Over long periods, REITs have returned about 9 to 10% annually, slightly lower than stocks, but higher than bonds, with more volatility than bonds, but less than stocks. A good middle ground. The expense ratio is 0.12%, slightly higher than the other ETFs because real estate investing involves more complexity, but still very low compared to actively managed REIT funds. Now let me address REIT concerns. Warren, didn't REITs get destroyed in 2008? Aren't they risky? REITs fell about 70% during the financial crisis because it was a crisis centered on real estate. Mortgages were defaulting. Property values were collapsing. REITs were at the epicenter. But in normal recessions, REITs hold up reasonably well. They own physical assets that generate rental income. As long as tenants pay rent, REITs can pay dividends. The 2008 experience was extreme and unlikely to repeat exactly. Warren, What about work from home killing office REITs? What about e-commerce killing retail REITs? Some property types face challenges. Office and retail REITs have struggled, but VNQ is diversified across many property types. Industrial REITs that own warehouses have boomed because of e-commerce.
Data center REITs have grown because of cloud computing. Cell tower REITs benefit from wireless data growth. Residential REITs own apartments that people need regardless of economic conditions.
The diversification protects you. Winners offset losers. Warren, aren't REIT dividends taxed inefficiently as ordinary income? Yes. Most REIT dividends are taxed as ordinary income rather than qualified dividends. This is a disadvantage. But if you hold REITs in a tax-advantaged account like an IRA, the tax treatment doesn't matter. Hold VNQ in your IRA. Hold VTI and VXUS in taxable accounts where you benefit from qualified dividend treatment. This tax-aware placement optimizes the portfolio. VNQ adds real estate exposure and extra income to the portfolio. It's the fourth piece of a complete investment strategy. Now let me bring all 4 ETFs together and show you how to build a complete portfolio. These 4 funds give you exposure to everything. U.S. stocks through VTI, international stocks through VXUS, bonds through BND, real estate through VNQ. This is total diversification across asset classes and geographies. The question is how much to allocate to each. The answer depends on your age and risk tolerance. Let me give you frameworks for different life stages. If you're young, in your 20s or 30s, you have decades until retirement. You can handle volatility. You should be aggressive. 70% VTI, 20% VXUS, 5% BND, 5% VNQ. This is 90% stocks, mostly US, with minimal bonds. Maximum growth potential. If you're middle-aged, in your 40s or 50s, you're building wealth but getting closer to needing it. Balanced growth and stability. 50% VTI, 20% VXUS, 20% BND, 10% VNQ. This is 70% stocks, 20% bonds, 10% real estate. Solid growth with some cushion. If you're approaching retirement in your 60s, you need to protect what you've built while still growing. 40% VTI, 15% VXUS, 35% BND, 10% VNQ. This is 55% stocks, 35% bonds, 10% real estate, more conservative with stable income. If you're retired in your 70s or beyond, preservation and income are priorities. 30% VTI, 10% VXUS, 50% BND, 10% VNQ. This is 40% stocks, 50% bonds, 10% real estate. Stability focused with enough stocks for inflation protection. These are guidelines, not rules. Adjust based on your specific situation. If you have a pension covering basic expenses, you can be more aggressive. If you have no other income sources, be more conservative. The key principle is that as you age, you shift from stocks to bonds, growth to stability, capital appreciation to income, but you never eliminate stocks entirely. Even at 90, you need some stock exposure for inflation protection. Now let me show you the power of this 4 ETF portfolio with specific numbers. You're 30 years old, you have $10,000 to invest. You allocate 70% VTI, 20% VXUS, 5% BND, 5% VNQ. That's $7,000 in VTI, $2,000 in VXUS, $500 in BND, $500 in VNQ. You add $500 per month. You invest for 35 years until you're 65. Assuming VTI returns 10% annually, VXUS returns 7%, BND returns 5%, and VNQ returns 9%. Your portfolio grows as follows. Year 5, about $45,000. Year 10, about $110,000. Year 15, about $210,000. Year 20, about $370,000. Year 25, about $600,000. Year 30, about $950,000. Year 35, about $1.4 million. You started with 10,000 and added 500 per month. You contributed about 220,000 of your own money. The rest, over $1 million, is investment growth. That's the power of consistent investing in low-cost index funds over decades. And this assumes you never increased your monthly contributions. If you increased them over time as your income grew, the ending value would be much higher. Now let me show you what happens if you make common mistakes. Same starting point, but instead of low-cost index funds, you invest in actively managed mutual funds with 1.5% expense ratios. These funds underperform the indexes by about 2% annually after fees and trading costs. Your returns are VTI equivalent 8% instead of 10%, VXUS equivalent 5% instead of 7%, and so on. After 35 years, your portfolio is worth about $900,000 instead of $1.4 million. You lost $500,000 to fees and underperformance, $500,000. That's the cost of not using low-cost index funds. Or let's say you panic during market crashes. In 2008, when the market falls 50%, you sell everything. You go to cash. You wait for things to calm down. But by the time you feel comfortable investing again, the market has already recovered most of its losses. You miss the recovery. Over your investing lifetime, this panic selling and market timing costs you about 40% of your potential returns. Instead of 1.4 million, you end up with 800,000. You lost 600,000 to emotional mistakes. Or let's say you try to pick hot stocks instead of buying index funds. You chase whatever is performing well. Technology stocks in the late 90s, real estate in the mid 2000s, cryptocurrencies in the late 2010s. You buy high, sell low, and constantly chase performance. Your returns lag the market by 3 to 4% annually. After 35 years, you have 600,000 instead of 1.4 million. You lost 800,000 to poor stock picking. These mistakes are not hypothetical. They're what most investors actually do. And they're why most investors dramatically underperform the market over their lifetimes. The simple 4 ETF portfolio eliminates all these mistakes. You're not paying high fees. You're not trying to time the market. You're not picking stocks. You're just owning everything and holding forever. Now let me talk about the specific mechanics of implementing this portfolio. Step 1, open a brokerage account. I'd use Vanguard since these are Vanguard funds, but Fidelity, Schwab, and other major brokerages also offer these ETFs with no trading commissions. Use a brokerage that doesn't charge commissions on ETF trades. Step 2, decide your allocation based on your age and risk tolerance. Use the frameworks I provided or adjust to fit your situation. Step 3, buy the 4 ETFs in your chosen allocation. If you have $10,000 and you want 70% VTI, buy $7,000 worth of VTI. The ETFs trade just like stocks. You place an order, specify the dollar amount or number of shares, and the trade executes. Step 4, set up automatic investments. This is critical. Have money automatically transferred from your checking account to your brokerage account every month. Then have that money automatically invested in the 4 ETFs according to your allocation. This removes emotion from the process. You're investing consistently regardless of market conditions. You buy when the market is up, you buy when it's down, you dollar cost average. Step 5, reinvest all dividends automatically. Every brokerage allows this. When VTI or VXUS or BND or VNQ pays a dividend, the money automatically buys more shares. This compounds your returns over time. Step 6, rebalance once a year. Once a year, check your allocation. If VTI is outperformed and is now 80% of your portfolio instead of 70%, sell some VTI and buy the other funds to get back to your target allocation. This forces you to sell high and buy low. It's a mechanical system that removes emotion. Step 7, adjust your allocation as you age. Every 5 years or so, shift slightly more from stocks to bonds. Move from an aggressive allocation toward a conservative allocation as you approach and enter retirement. This gradual shift protects you from sequence of returns risk. Step 8, ignore everything else. Don't watch CNBC. Don't read market predictions. Don't try to time the market. Don't chase hot stocks. Just stick with the plan, buy and hold. This is the hardest step because it requires discipline, but it's also the most important. Now, let me address the psychological challenges of this strategy, because this is where most people fail. The strategy is simple, but simple is not easy. Challenge 1, boredom. This portfolio is boring. You buy 4 funds and hold them forever. There's no excitement, no thrill of picking a winning stock, no drama of trading. For many people, this is unbearable. They need action. They need to feel like they're doing something. So they start tinkering. They add new funds. They try to time the market. They trade, and they destroy their returns. Understand that boring is good in investing. Excitement costs money. The investors who get rich are the ones who can tolerate boredom, who can buy and hold and do nothing for decades. If you need excitement, take up a hobby. Don't use your portfolio for entertainment. Challenge 2, comparison. You'll see other investors making huge gains on speculative investments. Someone will double their money on a meme stock. Someone will triple their money on cryptocurrency. Someone will brag about their returns. You'll feel like a fool for holding boring index funds that only go up 10% per year. This is when you need to remember that for every person who brags about doubling their money, there are 10 who lost everything and aren't saying anything. You only hear about the winners. The casino always shows you the jackpot winners. They don't show you the thousands of losers. Investing is not about hitting home runs. It's about consistently collecting singles and doubles for decades. 10% per year for 35 years turns 100,000 into 2.8 million. That's enough. You don't need to double your money in a year. Challenge 3, panic during crashes. This is the biggest challenge. When the market crashes 30 or 40 or 50%, every instinct tells you to sell. The fear is overwhelming. You feel like you have to do something to protect yourself. But selling is exactly the wrong thing to do. The investors who sell during crashes lock in their losses and miss the recovery. The investors who hold or keep buying end up wealthy. How do you avoid panic selling? First, expect crashes. They will happen multiple times during your investing lifetime. They're not aberrations. They're normal. Second, focus on the long term. You're investing for decades, not months. A crash is just a temporary setback. Third, remember that crashes are sales. Stocks you were happy to own at higher prices are now available at discounts. This is good, not bad. Fourth, don't look at your account balance during crashes. If you check your portfolio every day and watch it decline, you'll panic. Check once a quarter or once a year. Ignorance is bliss during bear markets. Challenge 4, temptation to add complexity. As you learn more about investing, you'll be tempted to add more funds. I should add emerging markets separately. I should add small cap value. I should add commodities. I should add international bonds. You'll think you're being sophisticated. You're not. You're making things complicated for no benefit. 4 funds is enough. VTI and VXUS already include small caps and emerging markets. Adding separate funds for them is redundant. BND already includes a mix of government and corporate bonds. Adding international bonds adds currency risk for a minimal diversification benefit. BNQ already provides real asset exposure. Adding commodities is unnecessary. More funds does not mean better returns. It means more complexity, more decisions, more opportunities for mistakes. Stick with 4. Challenge 5, trying to time the market. You'll think you can predict market moves. The market looks overvalued. I should sell and buy back cheaper. The Fed is raising rates. I should go to cash. There's going to be a recession. I should wait to invest. Market timing doesn't work. I've been investing for over 80 years and I've never successfully timed the market. I don't know anyone who has done it consistently. The market is unpredictable in the short term. You might get lucky once or twice, but over a lifetime, you'll make more mistakes than good calls. And one big mistake can wipe out years of good decisions. Just stay invested all the time in all market conditions.
The 4 ETF portfolio eliminates the temptation to time because you're always holding the entire market. There's nothing to time. Now let me talk about specific scenarios and how to handle them.
Scenario 1, you just got a $10,000 bonus. What do? Immediately invest it across the 4 ETFs according to your allocation. Don't wait for a pullback. Don't try to time it. Just invest it now. Time in the market beats timing the market. Scenario 2, The market crashes 30%. What do? Nothing. Actually, if you have extra cash, invest more. Stocks are on sale. Buy more of the 4 ETFs. This is a gift, not a crisis. Scenario 3, you're switching jobs and need to decide what to do with your 401k. Roll it over to an IRA. Then invest the entire balance in the 4 ETFs according to your age-appropriate allocation. Don't leave it in the old company plan with limited options and high fees. Scenario 4, you inherit $50,000. Same answer. Invest it immediately in the 4 ETFs. Don't overthink it. Don't try to be clever. Just invest according to your allocation and move on with your life. Scenario 5, you're getting close to retirement and you're nervous about market volatility. Gradually shift your allocation toward bonds over several years. Don't make sudden moves. Don't go from 70% stocks to 30% stocks overnight. Shift 5 to 10% per year over 5 years. This reduces the risk of making the shift right before a big stock rally. The key in all scenarios is consistency. Simple rules. No market timing. No emotional decisions. Just mechanical execution of the plan. Now let me address one final important topic. What if the U market structure changes dramatically? What if passive investing becomes so popular that it breaks the market? What if index funds create bubbles? These are theoretical concerns that some people raise about index investing. The argument is that if everyone buys index funds, no one is analyzing individual stocks. Price discovery breaks down. Bad companies get propped up because index funds buy everything. Good companies don't get rewarded because everyone just buys the index. This creates inefficiency and bubbles. I'm not worried about this for several reasons. First, passive investing is only about 40% of the U.S. market. The majority of trading is still active. There are plenty of investors analyzing stocks, making bets, setting prices. Second, even if passive becomes 70 or 80%, the active minority would have enormous opportunities to profit from any mispricings. This would attract more active investors, creating a natural balance. Third, index funds are not price insensitive. They buy and sell based on market cap. If a stock falls because it's overvalued, index funds own less of it. If it rises because it's successful, index funds own more. This is market cap weighting. It's self-correcting. Fourth, companies can still fail even if they're in an index. General Electric was in every index. It collapsed anyway. Being in an index doesn't protect you from business failure. The concerns about passive investing breaking markets are overblown. I'm confident that buying and holding low-cost index funds will work for decades to come. Now let me close with a story that illustrates why this approach works. In 1976, Jack Bogle founded Vanguard and created the first index fund available to retail investors. The idea was radical. Why pay high fees to fund managers who usually underperform when you could buy the whole market for almost nothing? Wall Street hated it. They called it un-American. They said it was settling for mediocrity. They said active management was worth the fees. But the data proved otherwise. Over the next 50 years, Vanguard's index funds beat about 90% of actively managed funds after fees. Investors who bought the original Vanguard index fund in 1976 and held it turned every dollar into about $150. Investors who chased hot mutual funds and paid high fees got maybe $60 to $70. The difference is staggering. And it all comes down to three things: low fees, diversification, and discipline. The 4 ETF portfolio I've described embodies these principles. Low fees through index funds, diversification across stocks, bonds, geography, and real estate, discipline through automatic investing and rebalancing. This is not complicated. You don't need a finance degree. You don't need to watch the markets. You don't need to read research reports. You just need to buy 4 ETFs, invest consistently, and hold forever. So here's my recommendation. If I lost everything and had to start over tomorrow, I would open a Vanguard account. I would invest in VTI, VXUS, BND, and VNQ. I would set up automatic monthly investments. I would reinvest all dividends. I would rebalance once a year. I would gradually shift from stocks to bonds as I aged. And I would ignore everything else. No individual stocks, no market timing, no complex strategies, just 4 ETFs and patience. That's it. That's the entire plan. And it would make me wealthy again over time. Not overnight, not through genius stock picking, just through consistent investing in low-cost funds that own pieces of thousands of businesses around the world. You don't need to be smarter than the market. You don't need to work harder than professional investors. You just need to own the market and let capitalism work for you. That's what these 4 ETFs allow you to do. And that's why, if I lost everything tomorrow, this is exactly what I would buy.
Let me go much deeper into why these specific 4 ETFs represent the optimal portfolio construction and show you exactly how to implement this strategy in different life circumstances.
Starting with VTI, I want you to understand not just what it is, but why total market exposure is superior to other approaches. Many investors think they should focus on the S&P 500 instead of the total market. The S&P 500 is 500 large companies. VTI is about 4,000 companies of all sizes. What's the difference? About 15% of VTI is mid-cap and small-cap stocks that aren't in the S&P 500. These smaller companies have historically provided higher returns than large caps, though with more volatility. From 1979 to 2023, small-cap stocks returned about 12% annually compared to large caps at about 11%. 1 percentage point might not sound like much, but compounded over decades, it's enormous. $100,000 at 11% for 40 years becomes $4.5 million. At 12%, it becomes $9.3 million. You doubled your wealth by capturing that extra 1% from small and mid caps. VTI gives you this exposure automatically. You don't have to decide how much to allocate to small caps or pick which small cap fund to use. VTI includes everything in market cap proportions. The allocation adjusts automatically as companies grow or shrink. Now let me talk about the mechanics of VTI's construction, because understanding this builds confidence. VTI uses a sampling methodology. It doesn't literally own every single stock in the US market. That would be impractical. Instead, it owns a representative sample that tracks the CRSP US Total Market Index. This index includes about 4,000 stocks, and VTI owns about 3,800 of them. The largest holdings, companies like Apple and Microsoft, are held in full. The smallest holdings are sampled statistically to represent their segments. This sampling introduces essentially zero tracking error. VTI's returns match the total market index within basis points annually. You're getting true total market exposure. The fund rebalances quarterly to maintain proper weightings as stock prices change. If Apple's price doubles and it becomes too large a portion of the index, VTI sells some shares to rebalance. If a small company grows into mid-cap territory, VTI increases its position. This happens mechanically without you doing anything. Now let me show you VTI's performance through major market events, because this reveals its resilience. During the dot-com crash from 2000 to 2002, VTI fell about 45%. Technology stocks that had soared in the late 90s collapsed. But because VTI owned the entire market, not just technology, it fell less than tech-heavy indexes. The diversification helped. More importantly, VTI recovered fully by 2006. Investors who held through the crash and kept buying accumulated shares at low prices and made fortunes as the market recovered. During the financial crisis in 2008, VTI fell about 51% from peak to trough. This was terrifying. Half your wealth disappeared in months. But again, investors who recovered completely by early 2013. The market bottomed in March 2009 and then began a bull run that lasted over a decade. If you had invested $10,000 in VTI at the absolute worst time, at the peak in October 2007, right before the crash, that investment would be worth about $45,000 today, despite going through the worst financial crisis since the Great Depression. The market always recovers, always, because the economy grows, companies adapt, innovation continues, and capitalism creates value over time. During the COVID crash in 2020,
VTI fell 34% in just 5 weeks, the fastest crash in history, but it also had the fastest recovery. The market bottomed in March 2020 and reached new highs by August, 6 months from trough to new highs. Investors who panicked and sold in March locked in massive losses. Investors who held or bought made extraordinary returns. I'm telling you these stories not to scare you, but to prepare you. Crashes will happen multiple times during your investing lifetime. They're not anomalies, they're features of the system. And every single time, the investors who held VTI and stayed invested came out ahead. Now, let me talk about VXUS in greater depth because international investing confuses many people. The most common question I get is, why own international stocks when they've underperformed US stocks for 15 years? It's true. From 2009 to 2024, US stocks crushed international stocks. The S&P 500 returned about 13% annually. International developed markets returned about 6%, emerging markets about 4%. This underperformance has convinced many investors that international investing is pointless. Just buy US and forget the rest. But this thinking is dangerously short-term. Go back to the 2000s. From 2000 to 2009, international stocks significantly outperformed US stocks. The S&P 500 had negative returns that decade, about minus 1% annually, including dividends. It was called the lost decade. Meanwhile, emerging markets returned about 15% annually, international developed markets about 5%. If you had abandoned international stocks in 2000 and said, I only need US stocks, you would have missed the entire decade where international outperformed. Markets cycle. Periods of US dominance are followed by periods of international outperformance. The cycle lengths are unpredictable. Sometimes US leads for a decade, sometimes international leads. You can't predict which will happen next. The only solution is to own both. VXUS ensures you capture returns from wherever they occur. You're not making a bet, you're diversifying the bet. Now let me explain VXUS's geographic breakdown because this affects your exposure. About 60% of VXUS is developed markets. Europe, Japan, Canada, Australia, UK. These are mature economies with stable political systems, established companies, strong rule of law. Think of stocks like Nestle, Toyota, Samsung, LVMH, SAP. About 40% of VXUS is emerging markets. China, India, Brazil, Taiwan, South Korea, Mexico. These are faster growing economies with younger populations, rapid urbanization, rising middle classes. Think of stocks like Tencent, Alibaba, Taiwan Semiconductor, Samsung, Infosys. The mix between developed and emerging adjusts based on market cap. As China's stock market has grown, it has become a larger portion of VXUS. As Japan's market has stagnated, it has become a smaller portion. This automatic adjustment is another benefit of market cap weighting. Within VXUS, the largest country exposures are Japan at about 15%, China at about 10%, UK at about 9%, Canada about 7%, and France at about 6%. You're diversified across dozens of countries and thousands of companies. Now let me address the China question specifically because it's on everyone's mind. China is about 10% of VXUS, which means it's about 4% of a 60-40 VTI, VXUS portfolio. Some investors are uncomfortable with any China exposure given geopolitical tensions, regulatory crackdowns on tech companies, and concerns about accounting fraud. I understand the concerns. Chinese stocks carry real risks. The government can and does interfere in private businesses. Accounting standards are not as rigorous as in the US. The legal system doesn't protect minority shareholders as well. But here's my perspective. 4% of your portfolio in the world's second largest economy with 1.4 billion people is not unreasonable. You're getting exposure to Chinese growth without making a concentrated bet. If China thrives, you benefit modestly. If China implodes, you lose 4% of your portfolio. That's manageable. Also,
Many Chinese companies in VXUS generate significant revenue outside China.
They're global businesses that happen to be domiciled in China. Tencent makes money from gaming worldwide. Alibaba has e-commerce operations across Asia.
TSMC manufactures chips for Apple and Nvidia. The Chinese stock label oversimplifies their business models. If you're truly uncomfortable with China exposure, you could buy VEA, Vanguard Developed Markets ETF, instead of VXUS. VEA excludes emerging markets entirely, so no China. The trade-off is you miss the higher growth potential of emerging markets. It's a personal decision. For most investors, I'd stick with VXUS for complete international diversification. Now let me talk about BND in much greater depth because bonds are the most misunderstood part of this portfolio. The role of bonds is not to maximize returns, it's to reduce volatility and provide stability when stocks crash. Think of bonds as insurance. You don't buy insurance to make money. You buy it to protect against catastrophic loss. Bonds protect your portfolio from the catastrophic loss of panic selling during a crash. When stocks fall 50% and you're watching your life savings evaporate, the temptation to sell is overwhelming. But if 40% of your portfolio is in bonds that are stable or up slightly, your total portfolio only falls 30% instead of 50%. This is psychologically manageable. You're less likely to panic. The bonds give you the emotional strength to hold your stocks through the storm. This is their true value. It's not about the 5% return from bonds. It's about preventing the catastrophic mistake of selling stocks at the bottom. BND currently holds about 10,000 individual bonds. These include U.S. Treasury bonds, investment-grade corporate bonds, mortgage-backed securities guaranteed by government agencies, and other high-quality debt. The average credit quality is AA, which is very high. The default risk is essentially zero. The U.S. government isn't defaulting on Treasury bonds. Investment-grade corporations very rarely default. Mortgage-backed securities guaranteed by Fannie Mae and Freddie Mac are backed by the U.S. government implicitly. Your principal is safe. The only risk is interest rate risk. If rates rise, bond prices fall. But BND has a duration of about 6 years, which is moderate. A 2% increase in rates would cause about a 12% decline in BND's value. Painful, but not catastrophic. And as I explained earlier, as bonds mature and are replaced at higher rates, the income increases and you recover. This happened in 2022. The Fed raised rates from 0 to 5%. BND fell about 13% that year. It was the worst year for bonds in decades. But in 2023, BND was up about 5% as the higher yields compensated investors. The temporary price decline didn't matter for long-term holders. Let me show you BND's role in portfolio protection with specific numbers from historical crashes. During the 2008 financial crisis, from October 2007 to March 2009, a portfolio of 100% VTI would have fallen 51%. $100,000 became $49,000. Terrifying. A portfolio of 60% VTI and 40% BND fell only 28%. 100,000 became 72,000. Still painful, but far more manageable psychologically. And here's the key. The 60-40 portfolio recovered to new highs by January 2013. The 100% stock portfolio didn't recover until March 2013. The recovery time was essentially the same. But the 60-40 investor experienced far less stress and was far less likely to panic and sell. The bonds didn't just reduce the drawdown. They reduced the emotional trauma that causes irrational decisions. During the COVID crash in 2020, 100% VTI fell 34%. 60% VTI and 40% BND fell only 21%. Again, bonds cut the pain in half. This matters enormously for staying invested. Now let me address the question of why not just hold cash instead of bonds. Cash currently yields about 5% in money market funds, higher than BND's 4.5% yield. So why own BND? 3 reasons. First, Cash yields are variable and will fall when the Fed cuts rates. If the Fed cuts to 3% next year, your money market yield drops to 3%. B&D's yield is more stable because it's based on the average yield of bonds with maturities averaging 6 years. It doesn't fluctuate as much with short-term rate changes. Second, bonds can appreciate in value when rates fall. If the Fed cuts rates from 5% to 3%, B&D would gain about 12% in value as existing bonds with higher coupons become more valuable. Cash doesn't appreciate. It just sits there. Third, bonds have historically provided better diversification with stocks than cash. When stocks crash, investors flee to bonds, driving bond prices up. This negative correlation provides portfolio stability. Cash doesn't have this dynamic. It just sits there yielding whatever the money market rate is. B&D is superior to cash for long-term portfolio construction. Now let me talk about VNQ in greater depth. Real estate is the most controversial piece of this portfolio because many investors already own real estate through their home. Why do I need REIT exposure when I own a house? Your home is not an investment in the same sense as REITs. Your home provides shelter. It might appreciate over time, but you can't easily sell a portion to generate income. You can't diversify it across property types and geographies, and it's highly concentrated. All your real estate wealth is in one property in one location. VNQ gives you liquid, diversified, income-producing real estate exposure that complements your home. VNQ owns about 160 REITs. Let me break down the property types in detail. About 20% is residential REITs. These own apartment buildings and manufactured housing communities. Companies like Equity Residential and Avalon Bay own luxury apartments in gateway cities. Companies like Sun Communities own mobile home parks. Residential REITs benefit from population growth and urbanization. People always need housing. Demand is persistent even during recessions. About 13% is industrial REITs. These own warehouses, distribution centers, and logistics facilities. Companies like Prologis own massive warehouse complexes near major ports and cities. Industrial REITs have boomed because of e-commerce. Every Amazon package has to be stored and shipped from somewhere. This structural trend continues as online shopping grows. About 13% is office REITs. These own office buildings in major cities. Companies like Boston Properties own Class A office towers. Office REITs have struggled because of work from home trends. Office utilization is down about 30% compared to pre-COVID levels. Many companies are downsizing their office footprints. This is a headwind. But VNQ's diversification means office is only 13% of the fund. If office REITs struggle, the other 87% can offset the weakness. About 8% is retail REITs. These own shopping centers and malls. Companies like Simon Property Group own premier malls. Retail REITs face pressure from e-commerce, but the best ones own necessity-based retail like grocery-anchored centers that are resistant to online competition. About 9% is specialized REITs. This includes data centers, cell towers, self-storage, healthcare facilities, and other niche property types. Data center REITs like Equinix benefit from cloud computing growth. Cell tower REITs like American Tower benefit from wireless data growth. These specialized property types often have the best growth prospects. The remaining portions include diversified REITs that own multiple property types in other categories. The key is diversification. VNQ doesn't depend on any single property type succeeding. Winners offset losers. Now let me show you VNQ's historical performance to calibrate expectations. From 2000 to 2023, VNQ returned about 9.6% annually, including dividends, slightly below stocks at about 10%, but above bonds at about 5%. A good middle ground. But VNQ is volatile. In 2008, it fell about 68%, worse than stocks. Real estate was at the center of the financial crisis. Property values collapsed. REITs couldn't access credit. Many cut dividends. It was brutal, but VNQ recovered. By 2011, it was back to pre-crisis levels. Investors who held through the crash and kept collecting dividends came out fine. In 2020, VNQ fell about 30% during COVID. Office and retail REITs were crushed as buildings sat empty, but industrial and data center REITs thrived. The diversification helped. VNQ recovered to new highs by late 2021. The volatility means VNQ is not a bond substitute. It's an equity-like investment with higher income than regular stocks. It belongs in the stock portion of your portfolio, not the bond portion. A 60% VTI, 20% VXUS, 15% BND, 5% VNQ allocation is really 75% stocks, 60 VTI plus 15 VXUS, VNQ blended, 25% bonds. Keep this in mind when thinking about risk. Now, let me walk you through detailed portfolio implementation for different investors to make this concrete. Investor 1, recent college graduate, age 22, has $5,000 saved, can invest $250 per month. Allocation, 75% VTI, 20% VXUS, 0% BND, 5% VNQ. That's $3,750 in VTI, $1,000 in VXUS, 0 in bonds, $250 in VNQ. Monthly $187.50 to VTI, $50 to VXUS, $12.50 to VNQ. Why no bonds? At 22 with 40 plus years until retirement, volatility doesn't matter. Maximum stock exposure for maximum growth. Bonds would just drag down returns. Expected outcome, assuming 9% annual returns and consistent monthly contributions. By age 65, this investor has about $2.1 million. Started with $5,000, contributed about $130,000 over 43 years. Investment growth generated $1.9 million. Investor 2, mid-career professional, age 40, has $150,000 saved, can invest $1,000 per month. Allocation, 60% VTI, 25% VXUS, 10% BND, 5% VNQ. That's $90,000 in VTI, $37,500 in VXUS, $15,000 in BND, $7,500 in VNQ. Monthly $600 to VTI, $250 to VXUS, $100 to BND, $50 to VNQ. Why some bonds? At 40 with 25 years until retirement, starting to think about risk management. 10% bonds provides modest stability without sacrificing too much growth. Expected outcome, by age 65, with 8% blended returns, this investor has about $1.6 million. Started with $150,000, contributed $300,000 over 25 years. Growth generated $1.1 million. Investor 3, pre-retiree, age 60, has $700,000 saved, can invest $1,000 per month. Allocation, 45% VTI, 20% VXUS, 30% BND, 5% VNQ. That's $315,000 in VTI, $140,000 in VXUS, $210,000 in BND, $35,000 in VNQ, $450 to VTI, $200 to VXUS, $300 to BND, $50 to VNQ. Why 30% bonds? Only 5 years until retirement. Can't afford major drawdown right before stopping work. Needs stability and capital preservation. Still enough stocks for growth. Expected outcome. By age 65 with 6% blended returns, this investor has about $1.1 million. Not huge growth because shorter time frame and conservative allocation, but capital protected. Investor 4, retiree, age 70, has $1 million saved, needs $40,000 per year for living expenses. Allocation, 30% VTI, 15% VXUS, 50% BND, 5% VNQ. That's $300,000 in VTI, $150,000 in VXUS, $500,000 in BND, $50,000 in VNQ. No more contributions. Withdrawal strategy, $40,000 per year taken proportionally from all funds. Why 50% bonds? In retirement, preservation is paramount. Can't recover from major losses. Needs stability and income. Stocks still provide inflation protection and growth. Expected outcome. With 5% blended returns and 4% withdrawal rate, portfolio sustains for 30 plus years and likely grows despite withdrawals. Dies with wealth to pass to heirs. These four examples show how the same 4 ETF framework adapts to different life stages. The funds don't change, only the allocation percentages change. This simplicity is powerful. Now let me talk about tax optimization, because where you hold these ETFs matters enormously. The U.S. tax code treats different types of investment income differently. Qualified dividends from stocks are taxed at 0, 15, or 20% depending on income. These are favorable rates. Long-term capital gains from selling stocks held over a year are taxed at the same favorable rates. Ordinary income from bond interest is taxed at your marginal income tax rate, which can be as high as 37%, much worse. REIT dividends are mostly ordinary income, also taxed at high rates. Given these differences, you want to hold tax-efficient investments in taxable accounts and tax-inefficient investments in tax-advantaged accounts. Here's the optimal placement. In taxable brokerage accounts, hold VTI and VXUS. These generate qualified dividends tax favorably. They're also tax efficient because they have low turnover. VTI only distributes about 1.5% in dividends annually. The rest of your return comes from unrealized capital gains that aren't taxed until you sell. This tax deferral is valuable. In tax-deferred accounts like traditional IRAs and 401k plans, hold BND and VNQ. The bond interest and REIT dividends are taxed as ordinary income, but inside an IRA you don't pay taxes until withdrawal and retirement, when you might be in a lower bracket. In Roth IRAs, hold VNQ and VXUS. The assets expected to have the highest growth go in Roth accounts because that growth is never taxed. VXUS has good long-term growth potential. VNQ has solid returns plus high dividends. Both benefit from tax-free compounding in a Roth. Let me give you a specific example of tax-optimized placement. You have $500,000 to invest, $200,000 in a taxable brokerage account, $200,000 in a traditional IRA, $100,000 in a Roth IRA. Target allocation: 50% VTI, 20% VXUS, 25% BND, 5% VNQ. That's $250,000 VTI, $100,000 VXUS, $125,000 BND, $25,000 VNQ. Here's how to allocate. Taxable account: $150,000 VTI, $50,000 VXUS. Traditional IRA: $200,000, $125,000 BND, $75,000 VTI. This uses up all your BND allocation in the tax-deferred account where bond interest isn't taxed currently. Roth IRA, $50,000 VXUS, $25,000 VNQ, $25,000 VTI. This puts your entire VNQ allocation in the Roth, where the dividends grow tax-free. Total VTI is $250,000, $150 taxable, $75 traditional IRA, $25 Roth. VXUS is $100,000, $50 taxable, $50 Roth. BND is $125,000 all traditional IRA. VNQ is $25,000 all Roth. You've achieved your target allocation while optimizing tax treatment. This saves you tens of thousands in taxes over decades. The exact placement depends on your specific account balances, but the principle is always the same. Tax-efficient investments in taxable accounts. Tax-inefficient investments in tax-advantaged accounts. Now let me address rebalancing in greater depth, because this is where many investors make mistakes. Rebalancing means periodically selling what's outperformed and buying what's underperformed to get back to your target allocation. This forces you to sell high and buy low. It's counterintuitive but powerful. Here's how it works. You start with 60% VTI, 20% VXUS, 15% BND, 5% VNQ, 100,000 total. That's 60,000 VTI, 20,000 VXUS, 15,000 BND, 5,000 VNQ. A year passes. Stocks have a great year. VTI is up 15%. VXUS is up 10%. Bonds have a bad year. BND is down 5%. VNQ is up 8%. Your portfolio is now VTI 69,000, up 9,000. VXUS 22,000, up 2,000. BND 14,250, down 750. VNQ 5,400, up 400. Total 110,650. VTI is now 62% of your portfolio instead of 60%. BND is 13% instead of 15%. your allocation has drifted. To rebalance, you calculate your target values based on the new total. Total is 110,650. Target VTI, 60% is 66,390. You have 69,000, so 2,610 of VTI. Target VXUS, 20% is 22,130. You have 22,000. Close enough. No change needed. Target BND, 15% is 16,597.50. You have 14,250 by 2,347.50 of BND. Target VNQ, 5% is 5,532.50. You have 5,400 by 132.50 of VNQ. You've sold 2,610 of VTI and use that money to buy BND and VNQ. You're back to your target allocation. You sold what went up and bought what went down. Over decades, this disciplined rebalancing adds about 0.5% to 1% to your annual returns. Doesn't sound like much, but compounded over 30 years, it's hundreds of thousands of dollars. The key is to rebalance mechanically once a year. Don't do it more frequently. Transaction costs and taxes add up. Don't do it less frequently. Your allocation drifts too far. Once a year is the sweet spot.
Some investors prefer to rebalance by directing new contributions to underweight assets rather than selling and buying. This works well if you're contributing meaningful amounts relative to your portfolio size.
If you have 100,000 and you're contributing 10,000 per year, you can rebalance through contributions without selling anything. But if you have 1 million and you're contributing 10,000 per year, contributions are too small to rebalance effectively. You need to actually sell and buy. Now, let me talk about dividend reinvestment, because this is a subtle but important decision. All 4 ETFs pay dividends or distributions. VTI pays quarterly, VXUS pays quarterly. BND pays monthly, VNQ pays quarterly. You can either take these dividends as cash or automatically reinvest them to buy more shares. During accumulation phase, always reinvest. This is non-negotiable. Every dividend that's reinvested buys more shares, which generate more dividends, which buy more shares. The compounding accelerates your wealth building. During retirement, it depends on whether you need the income. If you need 40,000 per year and your dividends generate 40,000, take them as cash. If your dividends generate 30,000 and you need 40,000, take the 30,000 as cash and sell 10,000 worth of shares to make up the difference. If your dividends generate 50,000 and you only need 40,000, reinvest the extra 10,000 and let your portfolio keep growing. The decision is based on your income needs, not on some abstract rule about always reinvesting. Now let me address one final critical topic. What happens when you die? This 4 ETF portfolio is designed not just to last your lifetime, but to pass wealth to the next generation. When you die, your heirs inherit your portfolio. If it's in a taxable account, they receive a step up in cost basis. This means the cost basis resets to the value on the date of your death. All the capital gains that accumulated during your lifetime disappear for tax purposes. Your heirs can sell immediately and pay zero capital gains tax. This is an enormous tax benefit. A portfolio that grew from 100,000 to 2 million over your lifetime has 1.9 million in unrealized capital gains. If you sold before death, you'd pay capital gains tax on 1.9 million. But if your heirs inherit and sell, they pay zero tax because of the step up. This makes taxable accounts actually more tax efficient than tax deferred accounts for wealth transfer. Your heirs inherit your IRA, but they have to pay income tax on withdrawals. No step up for IRAs. The entire balance is taxed as ordinary income as they withdraw it.
For building generational wealth, maximize your taxable account holdings later in life. The step up in basis benefits your heirs enormously.
Now let me close with a comprehensive example that ties everything together. You're 30 years old. You have $20,000 saved. You earn $60,000 per year and can invest 10%, which is $6,000 annually, or $500 per month. You open a Vanguard account. You invest the $20,000 as 70% VTI, $14,000, 20% VXUS, $4,000, 5% BND, $1,000, 5% VNQ. You set up automatic monthly investments of $500, $350 to VTI, $100 to VXUS, 25 to BND, 25 to VNQ. You reinvest all dividends automatically. You rebalance once a year in January. Every 5 years, you adjust your allocation to gradually increase bonds and reduce stocks. Age 30 to 40, 70, 25, 5 allocation. Age 40 to 50, 60, 20, 15, 5 allocation. Age 50 to 60, 50, 20, 25, 5 allocation. Age 60 to 70, 40, 15, 45 allocation. Age 70 plus, 30, 10, 55, 5 allocation. You never try to time the market. You keep investing $500 per month, regardless of market conditions. You experience multiple crashes. The market falls 30% when you're 35. You keep investing. The market falls 40% when you're 48. You keep investing. The market falls 35% when you're 62, right before retirement. But because 40% of your portfolio is in bonds, your total portfolio only falls 21%. Manageable. By age 65, your portfolio has grown to about $2.8 million. You started with $20,000. You contributed $6,000 per year for 35 years, totaling $230,000. The rest, $2.57 million, is investment growth. At age 65, you retire. Your expenses are $60,000 per year. Your portfolio generates about $50,000 per year in dividends and interest. You withdraw that $50,000 as cash. You sell $10,000 worth of shares annually to make up the difference. Your $60,000 annual withdrawal represents a 2.1% withdrawal rate on your $2.8 million portfolio. This is very safe. Your portfolio continues growing despite withdrawals because your returns exceed your withdrawal rate. At age 85, 20 years into retirement, your portfolio has grown to $3.7 million despite you withdrawing $60,000 per year for 20 years. You've taken out $1.2 million and the portfolio still grew by $900,000. At age 95, you die peacefully. Your portfolio is worth $4.2 million. You've withdrawn $60,000 per year for 30 years, totaling $1.8 million. And you're leaving $4.2 million to your children and grandchildren. This is the power of the 4 ETF portfolio. Simplicity, discipline, low costs, diversification, time. You didn't need to pick stocks. You didn't need to time the market. You didn't need complicated strategies. You just bought 4 ETFs, invested consistently, stayed the course through multiple crashes, and let compound interest work. That's it. That's the entire secret to building wealth. So here's my final answer to the question. If I lost everything tomorrow, what would I buy? I would buy VTI, VXUS, BND, and VNQ. I would allocate them based on my age and risk tolerance. I would invest every dollar I could as quickly as I could. I would reinvest all dividends. I would rebalance annually. I would ignore market predictions, news headlines, and everyone telling me they had a better strategy. I would hold through crashes, recessions, political turmoil, and any other crisis that emerged. And I would end up wealthy again, not through luck, not through genius, through the simple, boring, disciplined strategy of owning low-cost index funds and letting time compound my returns. This is what works. This is what has always worked. And this is what will continue to work for anyone with the patience and discipline to execute it. The 4 ETFs I've described give you everything you need. Global stock exposure through VTI and VXUS, bond stability through BND, real estate income through VNQ, complete diversification, minimal costs, maximum simplicity. If you do nothing else with your investments, do this. Buy these 4 ETFs, hold them forever, and let capitalism make you wealthy over time. That's my answer. That's what I would do, and that's what I recommend you do too.